In 2008, Wall Street banks took millions of volatile home mortgages, bundled them together, and stamped them as safe investments. We know how that ended. Today, that same financial engineering is being applied to the artificial intelligence boom. To see the physical scale of this bet, you have to look at the infrastructure. Every single week across America, multiple windowless data centers, each the size of a Walmart, are being constructed from the ground up. These facilities are not paid for with Silicon Valley cash. Long before a single server is plugged in, these buildings are buried under billions of dollars in borrowed money. Wall Street is taking that massive corporate debt, chopping it into layers, and selling it off as a new class of safe, reliable investments. The billions being spent to power everyday AI tools aren't just a tech industry line item. They represent a growing, hidden tie between the stability of the AI market and the broader financial system. Let's break down how one of these deals actually works. Imagine we're a private equity firm, and we've just negotiated a contract to build a brand new $100 million AI data center in Virginia. We don't want to tie up our own capital, so we only put down $10 million in cash. To cover the rest, we turn to private lenders and borrow the remaining $90 million. At the moment we sign that $90 million loan, the collateral backing it is an empty, dust-filled warehouse. It produces absolutely zero revenue. The lenders are making a bet that demand for computing power will explode, forcing companies like Google and Microsoft to sign multi-million-dollar long-term leases just to secure the space. But those tech giants are just tenants. If AI adoption slows down and they decide they don't need the capacity, they can walk away, leaving that $90 million debt with no income to pay it back. The private lenders issuing these loans know that walkaway risk is too high to hold on their own books. They need a way to pass the risk to the wider market. Wall Street's solution is to take hundreds of these individual data center loans and package them together into one massive, unified column of debt. To make this bundle appealing to buyers, they slice it into layers, or tranches, and rate them based on how likely they are to be paid back. Today, Wall Street is demanding the high payouts typical of risky bets because they know exactly how much unproven debt is hiding beneath the surface. The chain of dependency is set. Retirement funds rely on bond payouts. Those bonds rely on bundled debt, and that debt relies entirely on warehouse rent. Holding up the entire stack is one narrow assumption, that AI demand will grow forever. But what happens if AI models hit a performance ceiling, or the cost of training them outpaces the profit they generate, and big tech companies stop renting new space? If the rent stops, the individual loans default. When those loans default, the Wall Street bonds collapse, and the financial hit lands directly on the retirement accounts holding them. The trillions of dollars currently driving the stock market are sitting on top of a massive debt-fueled gamble. The risk has already been successfully passed down the line. The money is spent, the trap is set, and the global economy is forced to wait and see if AI changes the world, or if it just... To understand the scale of the current debt, we have to look at the physical footprint of the AI boom. Tech companies like Oracle are borrowing billions of dollars right now to build massive data centers. These facilities are being built for OpenAI, a company that is currently burning billions of dollars while generating zero profit. Oracle is taking on massive debt, betting entirely on the hope that OpenAI will be able to pay the rent. This risk is showing up in the credit market. This chart shows the cost to insure Oracle's debt through credit default swaps. That insurance cost recently tripled, spiking to levels we haven't seen since 2009. When insurance costs jump this fast, it means professional investors are betting that Oracle may not get paid back. It marks the first significant crack in the debt-fueled infrastructure of AI. Consider a scenario where OpenAI is forced to cut its rent payments by 30%, squeezed by the rising costs of the water and electricity required to run its servers. That single missed payment would trigger a chain reaction. Rating agencies would be forced to downgrade Oracle's bonds to junk status, and construction on new data centers would stop immediately as the ability to borrow more money disappears. In 2008, when the housing market crashed, banks could eventually resell foreclosed homes. You cannot repurpose a data center into office buildings or apartments. These facilities are specialized, permanent structures that have no alternative use if the primary tenant fails. With billions in construction frozen and bonds downgraded, The question becomes whether this failure remains isolated or triggers a wider financial crisis. To find the answer, we have to look at where the risk is hidden. Back in 2008, the toxic mortgage risk lived inside the big banks. They held the loans, they packaged them, and traded them, making the entire global banking system interconnected and vulnerable to a single failure. Today, the model has shifted. Banks are making fewer of these loans, instead passing the debt to private credit funds and other private investors. These private institutions are taking on the risk that banks avoid, chasing higher returns by funding the massive infrastructure projects the AI industry demands. This shift means a collapse in AI debt is unlikely to take down the global banking system. The firewalls will likely hold, simply because the risk has been completely moved off the major banks' balance sheets. This isn't the first time we've seen this kind of infrastructure boom. In the 1990s, telecom companies spent billions laying thousands of miles of fiber optic cable. When that bubble burst, nearly 95% of those cables sat in the ground, unused and written off as a financial failure. But those exact cables eventually became the foundation of the modern internet. They are the reason we have the bandwidth for streaming and social media today. Even if the current financial hype is ahead of reality, the demand for AI computation may eventually catch up to the supply. The data centers being built now are long-term physical assets, even if the money behind them is volatile. The financial engineering may fail in the short term, but the underlying infrastructure remains a permanent addition to the economy. While the global banking system may be protected, the exposure has landed elsewhere. Private credit funds often manage money for institutional investors, including pension funds. Norway's $2 trillion sovereign wealth fund provides a perspective on this risk. They are among the most conservative investors on the planet. They are actively avoiding AI data centers because it is still unclear whether these facilities will generate a profit. Other funds, however, have already committed capital to these projects in search of yield. This creates the conditions for a quiet collapse. The losses will accumulate slowly in retirement accounts and pension funds, happening out of sight until the impact is already irreversible. This financial reality connects directly to the anxiety many feel about AI disruption and job losses. Innovation has historically continued regardless of financial market cycles. The shift toward AI is already integrated into the industrial landscape. You have two choices: ignore the shift and remain exposed to its risks, or understand these underlying financial mechanics to stay ahead. Those who recognize how the rules of money and power are changing will be the ones to navigate this transition. Whatever you decide, don't wait until the quiet